Actually, the idea is to learn, of course, to learn how to calculate the ratios, but also how to interpret them. So the basis and the focus of these exercises over here is in the calculation, computation, but more on understanding the effects of transaction on different ratios, and also being able to analyze the information and interpreting them. One favorite kind of exercise that you may have noticed is the one when you are given various ratios and you have to assess and understand the impact of a specific transaction on a certain ratio. You will see this repeated with other kind of ratios later, but the idea under this kind of exercise is to understand what a certain transaction, which are common business events for a company, what a certain transaction can bring to the financial indicators. There may be various ratios like liquidity, performance. For example, in this exercise, we have 5 different transactions, and we have to state what is the impact of each of the transactions on the certain ratio included there. It's a good thing to remember the formula for each of the indicators. That will help you to understand, and also to be able to focus only on this specific transaction. Do not think what will this bring in the future. Just think about the immediate effect or the immediate outcomes of this specific transaction over here. So we start with the issuance of a stock dividend. Now remember that what we consider a stock dividend was the same as having a bonus issue. We have called the bonus issue the stock split or the stock dividend the same thing. That is increasing the number of shares outstanding without having any increase in the earnings, right? So if we know that the earnings per share, the formula for earnings per share is net profit after the dividends of the preferred shares, so that there is net profit available to the shareholders, divided by the number of shares. That is the formula for the earnings per share. If we issue some stock dividend, that means that we increase the number of shares outstanding, but we do not have any change in the net profit. The total effect of the earnings per share will be a decrease in the value. Therefore, we put here a minus to show that most likely this transaction will cause the earnings per share to diminish, to decrease in its value. Is that clear? Or okay, we can continue that, and that is clear. We have the same ratio, the same earnings per share, but the transaction right now is the collection of accounts receivable. Obviously, the collection of account receivables does not change the number of shares outstanding, and obviously the collection of money from customers does not change the net profit either. The net profit will be increased whenever I sell to the customer, whenever I have a revenue. But when I collect money from previous revenue transactions, we do not have any new revenue, therefore no increase in the net profit. That is no effect, zero impact on the earnings per share due to the collection of accounts receivable. Okay? Any question for that? If not, we can continue. If yes, you can write in the chat and we'll take your questions. The next ratio is the net profit margin. Can we remember the formula? It is useful in this tutorial to remind ourselves of the formulas. I know that for the moment you are not memorizing them because for the group project you have to check them, but for the purposes of the exam you have to remember the formulas. So let's remind ourselves every time. So net profit margin is the ratio between net profit and the sales. Whenever you hear the word margin, that means that the sales will be in the denominator always. So, what is the effect of the rise in cost of goods sold in the net profit margin? Now, I think this is easy. If we have a substantial increase or rise in the cost of goods sold, cost of sales, that means that the net profit will decrease, whereas the sales will increase as well, because we have a rising cost of goods sold, and whenever you sell something, you also have revenues. So that means that the sales will increase, right? Because we are selling. The cost of goods sold is increased when you sell something. Okay? So you are selling, the sales are rising, and in the meantime, the net profit is decreasing. The value of the ratio itself, mathematically, if you have a ratio whose numerator is decreasing and denominator is increasing, the value of the ratio itself will go down, will decrease, okay? So it's a minus here. Return on capital employed. What about the return on capital employed? The firm has a 10% increase in profit. What does that make, or how does that change the return on capital employed? Shall we remember the formula together? How do we calculate the return on capital employed? Earning before taxes plus long-term interest. That is divided
Net asset.
net assets, which is basically the sum between equity plus the long-term debts. The net assets you can also calculate as the difference between total assets and current liabilities. So we have two ways to calculate that. Questions?
The return on capital employed and the net profit margin does not have the same numerator.
Sorry?
The return on capital employed and the net profit margin
Yes?
does not have the same numerator.
The same numerator?
Yeah.
Mm.
Because the return on capital employed is formed by the net profit margin multiplied by the volume of trade, right?
That's a very good point. We also know that the return on capital employed is represented or can be disaggregated in two components, as we said, and we can also use that information. Thank you. And that is the multiplication between the net profit. It's not exactly the net profit, it's the adjusted profit actually over here, but I'm saying profit margin multiplied by
The volume of trade for assets.
trade volume or the asset turnover in a certain way.
Yeah.
Okay, if we have, that is an easier way to tackle this transaction. If return on capital employed is composed of two different elements, one of which is the profit margin, and the profit margin is increased by 10%, how the return on capital employed will change. In this case, I would wonder if the increase in 10% of profit has caused any change on the trade volume, because you may have a 10% increase in the profit margin, but if the trade volume is decreased by more than 10%, then the two ratios together, which is the ROCE, maybe it's not increasing. So you have to decide in this moment if the increase in 10% of the profit will have an impact on the trade volume. What do you think? Does it have an impact on the trade volume? Remember, trade volume is sales to long-term capital. Can you decide that? Can we decide that? Feel free to do that. So again, what I'm saying, please. I'm saying that, okay, we know that the profit margin is increasing by 10%, right? Do we know anything about the trade volume?
No.
Remember that the trade volume is sales to equity plus long-term debt. Now, I may say something. What if the 10% increase in profit has come because I am selling more? And if I sell more, I have an increase in the sales. And if I have an increase in the sales, I have an increase in the trade volume as well. You see what I'm saying? Okay. So, what I'm trying to say is that, of course, you have the information of the two components that are part of the return on capital employed, but it's not easy. It's even more difficult for you to understand the impact of one ratio or one transaction on two ratios in the same time. Don't complicate, in my opinion. Don't complicate stuff. You have to think two things here. Okay, the net profit margin is increased, but what about the trade volume? The increase in the profit may come because we are selling more, we are selling with higher prices, we have a decrease in our costs, we don't know what is causing that. So if we have different reasons for the increase in the profit, we don't know the effect it will have in the trade volume.
My question was, why do we use the net profit in the net profit margin and the EBT plus long-term interest in the promotion? If the multiplication doesn't match, no. I mean,
Yes, but
it's
right here I'm not saying net profit margin. So this is the profit margin. And this is the adjusted profit margin for the purposes to use in the return on capital employed over here. Okay, I'm trying to finalize this transaction and coming back to your question. This is something that we already discussed with some of your other friends through email. They've been asking and we clarified this with them. I will come back to that question for you. So let us first calculate what is the impact of the increase in profit. If we have this ratio over here. If we have a 10% increase in profit, the numerator will increase, that is the earning before taxes regulated with long-term interest, but we have no change in equity or long-term debt. That is, if we have an increase in the numerator of the ratio itself will become larger, will increase. Are you okay with that? That is understandable. Now, the question of your friend, which I misunderstood, was why do we have here profit margin and not net profit margin?
Yes.
Okay?
Yes.
Because we have done something else somewhere else?
Yeah, in the slides we have net profit margin multiplied.
Probably it's a lapsus or a problem. Okay? I have to check with the textbook. It's not net profit margin because as you can see, the return on capital is derived. I will just write here if you don't mind. That is earning before taxes plus long-term interest to sales multiplied. The second ratio is sales to the sum of equity plus long-term debt. Okay. So mathematically, that is not difficult. Sales to sales are out of the equation, and what we are left with is earning before taxes plus long-term interest divided by equity plus long-term debt. Okay? So this is the basic formula. This means that this first component over here is not the net profit margin, is a profit margin. All the lines or items of profit, if you divide them by sales, are a profit margin. Therefore, you have gross profit margin, net profit margin, adjusted profit margin. I have to check that. But obviously, that is not true. Because net profit margin is net profit to sales, whereas this is not net profit. Actually, it is earning before taxation, adjusted with the long-term interest. It is not EBIT as well, so be careful. We took EBIT as an approximation, but it's not the same as earning before interest
最后
and
就是把
taxes.
所有的 tax
So thank you for
全
bringing
减
that
了
to
以后
my
才出
attention.
来。
I will check
那
the
这个
slides and I
就
will
是
make the correction there. Okay, so we are done with that. Return on assets. Net income increases by 20%. Return on assets is the ROA. Usually it is the ratio between the operating profit, so EBIT, with the total assets. We have an increase in net income. Most probably this increase will derive from a similar increase in the EBIT itself. So if we increase the profits with no change to the total assets, the same ratio will also increase. So it's a plus sign over here. Okay? I hope that was clear. Any question through the chat? We don't have any. Any comments or something unclear here? Obviously not. Okay. So let's see the problem 2. We have some selected data from company. And basically what we have here is the statement of financial position. You see the items of current assets, investments, and the non-current assets as well. We have information about total liabilities and stockholders' equity. We do not have information about specific items in the liabilities. So there is no information there about current, non-current, or trade payables. We also have information about selected data from the income statement. That is net sale, cost of goods sold, CGA, and interest expenses, and of course net income or net loss. You can see that for both years the company is experiencing net losses, and actually the net losses are really increasing from one year to the other, so that's not a good thing for the company. But also, as we may notice, from 2019 to 2020, you can see that what you are experiencing is a decrease in the total financing or investment. From 1,237,000, you have a decrease in the total assets, total investments in 1,161,000. So for each year, we are required to calculate the interest coverage ratio and several ratios over there. And we also are required to comment on the results of the ratios calculated in this requirement, and then we have to answer. Okay, we can do like that to have it more clear. I'm starting with the interest coverage ratio. Right here I will put the years, 2020 and then 2019. Do we need to remind the formulas? Let's do that. Okay, so the interest coverage ratio is actually the ratio between EBIT and the interest expenses. Okay, in order to have some time, to not take time right now to make the calculations, I have the solution of the exercise. Do you agree if I just take the data and the results immediately, not to lose time with making the calculations? Okay. You can try for yourself, or you can prove the calculations, okay? So, right here we have a 2020. If you make the calculation, it will be minus 7.45 times. Remember that the interest, okay, I understand now your confusion. We have the net income here only. So in order to calculate the EBIT, earning before interest and taxes, we start from the net income and we add back first taxes if we have them, and then interest. In this case, we do not have any tax expenditure, so we just add back the interest expenditure. Okay? So for example, for 2020, it will be 337 plus 40,000. That would be divided by the interest expenditure, which is 40,000. Okay? That would be equal, I'm just illustrating. work? Okay, whatever. So the way we calculate the interest coverage for 2020 will be this one y, because we do not have the EBIT here in the structure, and we have to calculate starting by the net income plus interest expenses, okay? But remember, net income is a net loss, is with a minus. So put minus plus 40,000, then divided by 40,000 should equal this amount over here. Is that clear for everybody? Do we need to perform any calculations? Did you check the calculation for yourself? Is it okay? Thank you. Please make sure that you know how to do that right now in case I have anything wrong or a lapsus or a simple error. Please let me know. Can you do the same for 2019? Okay? Okay, I'm leaving that to you right now. For 2019 it will be, the loss is 225,388 plus 30,000, the interest expenditure divided by 30,000. How much is that?
Minus, say,
Can you calculate this, please?
say 0.51.
I come prepared. I made the calculations before I came here to not lose so much time, but I need to make sure I am right. Please, I have a value.
6.51.
Okay, so it's okay. What I've done is okay. Thank you also to the chat. Thank you, Federica. Okay, so if you try to calculate this, it is 6.51. What is this? Is this a percentage or times?
Times.
Okay. Sometimes this is the biggest problem when you try to calculate some ratios. We'll see later at the z-score. This is a source of big confusion, and it may cause you to calculate the wrong value. Please be sure that unless you multiply a ratio with 100, it is not a percentage, it is in times. Okay, so make sure how to understand what you are calculating over there. Okay, so it's 65%. Right now, I'm just taking everything out because we are interested to know only the values of the ratios. So it is 7.45 times in 2020, and 1 week ago it was 60.51. Okay, yes.
The result is not negative.
It's negative.
Is not?
Negative.
Really?
Because we have a negative numerator divided by a positive denominator.
Yes, you're right. Actually, I started with that. If you remember, it was in brackets. Okay, sorry about that. Thank you. I have not a very friendly keyboard. I have problems with my eyes and my glasses, so you will excuse me all the troubles, okay? Thank you. So we continue with the debt ratio. Yes. The denominator? Because we take the absolute value of the expenditure, not the expenditure. We show the expenditure in the income statement with minus to make a distinction between revenue and expenditures. But in itself, when we use the expenditure in different ratios, not only this one, we will take in consideration their absolute value, not with their signs. With expenditure. Now, what I'm trying to do here with this ratio, the interest coverage ratio, I'm trying to understand if I am generating enough operating profit to cover for the interest and hopefully to have some money left for the net income for the shareholders. That is, it doesn't make sense if I take a profit, which is positive, in other cases, in this case it's negative because it's a loss, but it doesn't make sense if I take a profit and I calculate with an expense and put a minus in that, because it doesn't make any sense. Now remember, all the ratios should make sense. Otherwise, we are not getting nothing out of our endeavors right here, trying to calculate many things. The idea of this ratio is to understand, am I covering the interest or not? And if I cover the interest more than 5 times, I'm good. Up to 8 times, it's okay. More than 8 times is favorable, but sometimes it's not achievable. Less than 5 times would be considered risky from some banks. And probably when they consider if you are eligible to take another loan or not, most probably if you have an interest coverage ratio less than 5 times, you will not get the loan that you are looking for, because the bank may consider that you are unable to cover the loan service costs. I'm not sure if that is okay. Did we answer your question? Okay. Any other questions, please? The debt ratio over here. Remember the formula?
I want to ask, interest coverage ratio now is minus, so it means it's less than 5.
It's even worse.
Okay.
It's minus, that is very, very worse.
Okay.
Minus means that I'm not generating a profit, I'm at a loss even before the interest expenses. Now, is that normal? If this company is a new company, it has been opening in 2019, normally in the first year of the life cycle, the companies are not generating profit. They are still operating at loss. So is this normal? Yes, this is normal for a new company in the introductory phase in the life cycle. But if this continues for more years, way into the growth stage or maturity stage, probably the banks that have delivered these loans, over here you see that we have liabilities considerable. The companies that have delivered these loans, they will reconsider their position. So they would think again if they have to call back the liabilities or not. Something else that you might want to discuss, but maybe we can wait for that later. You can see that the interest coverage ratio is not good, it's becoming worse. But you see something else as well. In the meantime, the total liabilities are going down. So it's not that I'm having more debt to pay more interest, okay? As you can see, the interest expenditure is increasing from one year to the other, and that accompanies the decrease in the profit. They both are bad things, but having in mind that this happens in the context of not increasing debt, this means a very risky company. That means why a company that does not have more debt should increase the interest expenses. Do you understand that? So this is something that you have to remind yourself when you interpret the interest coverage. Okay, it's being deteriorating from one year to the other, but why is that? Is that because I have more liabilities? Is that because the interest rate in the market are increasing? Or is that because I have less profit to cover these interest expenses? So there may be different factors that you have to consider when analyzing and interpreting. Calculating the value is one thing, and having feedback and analyzing is the other thing. Okay, we at a certain moment later will combine the interpretation together. So again, the debt ratio, which is the formula.
Total liabilities
Okay.
divide the total assets.
Sometimes it's known as the gearing ratio or the financial leverage ratio. It's the same thing. Basically, it is easy to calculate total debt to total assets. So if we perform the calculations, now again, to not lose time, 59.4%, the total debt ratio compared to 58.3% 1 year ago. This is something that actually we expected since we saw the decrease in the value of total liabilities. Okay, we have an increase in the debt ratio. What does that mean? We have decreasing the total liabilities, but the total debt ratio that compares these total liabilities to total assets has been increasing. Any comments? It's not difficult to understand why. Any comments on that?
Asset is
Mm-hmm.
becoming less than previous.
Okay, so we can see that the total assets or total liability and equity is decreasing at a faster rate than the total liabilities. This company is performing into a smaller scale, from 1,237,000 to 1,100,000, but as it is reducing the activities, the amount of the liabilities is not reducing at the same scale. It is reducing slower, at a slower rate. And this explains the increase, very modest increase, I would say, in the debt ratio and in the debt weighting factor in the financial structure. Still, it is not something that we may consider as problematic for the company, because the term of increasing the debt ratio is very low. From 58 to 59%, it does not represent a big increase. Still, we have to keep in mind that the company is actually reducing its activities. The total debt ratio is being slightly increasing. Maybe this will present problems in the future, but not now. Okay, questions? Okay. But we can also continue to calculate the total debt to total equity ratio. That would be total debt to total equity. And we perform the calculations. We can say this is 146%, and that is 140%. Now, something to remember here, when we explained the interpretation of the debt ratio, remember that we said that an optimal, very broad average value is around 50% of this ratio, but that should be considered and interpreted in very large intervals, because it may be affected from two factors. The one is the sector where the industry is operating. Sometimes it is acceptable for a certain industry, for example, financial companies, to operate with total debt ratios at 80% or 90%. If you analyze a bank or a financial company, you will find a safely debt ratio about 85%, and that's okay for them. Another factor to consider is the risk exposure. For certain individuals, certain management structures, it may be okay to undertake more risk than other individuals or other management teams. And that is not something bad or good necessarily in itself. The outcomes will depend on the economic growth or economic recession. Usually the companies that undertake a lot of risk will earn more under economic growth, but will fail more as well when we have recession. Whereas the companies that do not undertake a lot of risk, they will earn less when we have a growth economy, but as well they will lose less when we have a recession. So it's what you are prepared to deal with. Do you want to take risk? Okay, prepare to profit more, but prepare also to lose more if you have a downturn of economy. Okay, so keep this in mind when we interpret the debt ratio. We are not far from a 50% optimal value. We have a slight increase, but still it's not something to worry about. I'm sure that if you have calculated this ratio for your companies, you may have taken values like 60% or 70%. Am I right? For your group or project, if you have calculated this ratio, you may take very large values out of that. That's not to be worried about. Okay, so right here we have to calculate the net profit margin. The net profit margin, as we said before, is the ratio between the net profit and the sales. I'm not writing again the formula over here. So the net profit margin, if we make the calculation, is minus 60.7%. Remember that we have a net loss actually. And 1 year ago it was again a net loss, 12.2%. That means that the net loss has been even worse. We have a decrease in the net profit. In this case, it's a net loss. It's a net loss margin. Okay. The other thing that we are required to do is the gross profit margin. As we said, whenever we have a margin, sales should be in the denominator, and that line of the profit should be in the numerator. So gross profit to sales, that is gross profit to sales. If we perform the calculations, okay, we find something interesting in the value that we find. It's only 0.1%, whereas 1 year ago it was 3%. Usually the gross profit margins are not so low. If you have calculated the gross profit margin for your own companies, usually they are about 15-20% for most companies, because having a gross margin 15 to 20% leaves room to cover for the other operating expenditure. A gross profit of only 3% and let alone 0.1% does not leave room for covering the further expenditure, like CGA or interest expenditure. And the decline in the gross profit margin is even worse. So it's not big enough to start with, and its decline from 1 year to the other means that we do not have any capacity to cover any other expenditure other than cost of sales. I think that is understandable. What I'm trying to say here is that almost all the value of net sales is used to cover for the cost of sales. You cannot cover anything else. You cannot cover the selling expenses, the general or the administrative. The idea is that the gross profit, the difference between net sales and the cost of goods sold, should be between 15 to 20% of the sales, and that leaves room for the company. It gives some possibility to cover the selling, general, and administrative expenditure. Usually this item for most companies around between 10 or 15% of the total revenue always. In case you have a gross profit less than 15%, this does not give you any space to cover for the general expenditure that you are having. Okay, total assets turnover. Whenever you hear the word turnover, sales are in the numerator always. So we have sales to assets. Okay, if we 1.74 times, and 1 year ago it was 1.49 times. What can we say about this value? Some attempt to interpret on the value of the total asset turnover. If we remind ourselves of what we discussed when we presented the ratio, usually the total assets turnover for a big company that is operating in the maturity stage of its life cycle, usually this ratio should be around 1 or 100%. That means that for a big, consolidated and safe company, I would like the turnover or the sales to be at least in the amount of the total assets. That is, a company is expected to generate the same amount of sales as the amount of assets is utilizing, okay? So normally I would expect this turnover to be 100% or 1. Of course, you can apply large margins to this interpretation because this varies widely on the sector where the company is operating. That means that if we are at this value over here, 1.49 times, that means that we are not bad. We are generating revenues more than the amount of the assets that we have been investing. That's okay for a company. Okay, you have like that for your own investment. If you invest a certain amount of money and in 1 year you generate more money that you have been investing, that is okay. The increase of this asset turnover over time is even better. But consider, when you interpret or when you see an increase in the ratio, Look very carefully, why is that happening? The net sales from one year to the other actually have increased. We have a question in the chat that I'm taking in a bit. So we have an increase in the net sales, as you can see over here, associated with a reduction in the total asset. And that explains the observable trend over here. So we are generating more revenue with the least amount of investments that we are taking. This is, if the other things are not positive for this company, at least this is something good to comment on. So the increasing trend of the asset turnover, that's a good point for the company, okay? The problem of this company is managing expenditure, very low gross profit margin, inability to cover expenditure, whereas the ability to generate revenue from utilizing assets is okay. Okay? So the return on assets, the last ratio over here, probably it is known as the ratio of EBIT divided to total assets. Something that I always skip, I don't mention. Whenever it is possible, you can make the calculation based on the average values. We mentioned that when we explain the ratios, but I'm emphasizing right now. That is that in other cases, I would calculate the return on assets for 2020 by dividing EBIT for 2020 with average assets, that is opening balance from 2019 plus closing balance divided by 2. Why do I not do that? Because I would lose the benchmarking of comparing with the previous year. If I would be based on the average value of assets, I would be able to calculate a ROA for 2020, but if I try to do the same thing for 2019, I cannot do that because I lack the amount of 2018 to calculate the average assets. That means that I will lose the benchmark, and having a benchmark against which to compare a value of a ratio is very useful in analysis. So again, whenever you have the possibility, prepare to be used the average values, or when the exercise in the exam will specifically tell you base your calculations on average value, follow those instructions. But if it is not mentioned, try to have the benchmarking of comparison to the previous year. That is, base your calculations on the ending values or the closing balances, okay? I would like your permission to have a look at the chat. Maria, in the guidance for the group work, I mentioned that calculations must be included in the presentation. That obviously means that I do not need all the steps of the calculations. Probably that means that I will want you to put a simple formula for the ratio, okay, but I do not want you to show all the steps of the calculations, if that was not clear. Is that okay and understandable for you now? So again, not every step of the calculations, Maria, that's not necessary. Only the value of the ratios and the simple interpretation. Okay, after we make the calculations for the ROA, we find that it is minus 26% for 2020. And for 1 year ago, it was minus 16%. What can we say about ROA? Of course, we have specified that this ratio specifically tries to measure the productivity or performance of the company. That is, how able is the company to generate operating profit out of the total investments in assets. We want a higher, as much higher ROA as possible, a positive value of course, and when we find that we have a negative value over here and a deteriorating ratio, a ratio that it is being reduced over time from minus 16 to minus 26%, that is not something that we can say it's a good thing for the company. Now, the requirement B is comment on the results of the ratio. This is something that we already did by calculating the ratios and commenting. We have fulfilled the requirement B over here. You are required to do the same for the group work and also for the exam. Calculate one ratio and have some comment, something to say about that. I'm not asking that you will perform, of course, rocket science here, but you can be able to understand if a ratio is high or low, and if it is being increased or decreased, and what does that mean for the company. If we can make a summarization of what we observed over here, what can we say? Who can tell me? First thing, profit margins are quite low. So this is something not to be happy about. Profit margins of the company are really very low. And I would even add, even though the sales are increasing, okay? So the sales are increasing from one year to the other, and other things being equal, I would expect to have an increase in the profits as well, but that is not happening. So this is something really to put in red lights and to see very carefully in the future how it will go on, this trend in the profit margin. Something else that we might have noticed, the total investments of the company are squeezed down, are being reduced from one year to the other. And that is something that it's not bad, necessarily bad in itself, but accompanied with the increase in the revenue, it should be investigated further. Why did that happen? Something that I may notice at the first glance over here, something to worry about, is the decrease on the total equity. Probably that came because we have a negative or we have a loss for both years, and having a loss that will be transferred to the retained earnings means that we'll have a decrease in the equity. Of course, that might be an explanation, but still this is something that we have to keep an eye on. In the future we have to be very attentive, and we have to look what will happen with the company. Something else to add that you may have noticed during the ratios? The financial structure, what would you think about the financial structure? Seems okay, under control, something to worry about? Seems close to optimal. So the financial structure seems close to the optimal value with a very slight increase, but that we did not recognize as a problem area in the company, okay? So these again are comments that we do now in advance or in complementing the comments that we did for every ratio over here. Obviously, I cannot write everything that we talk and we mention, but I hope that you are taking notes to write what we are commenting on the ratios. Any questions so far? Anything to ask? Okay, we have a question, very specific one. If we have an interest coverage ratio, which is less than 1:1. In our case, it was even negative. But if we have a ratio less than 1:1, does that mean that the firm cannot pay its interest expenses? I want your opinions, your smart and wise opinions about that. Yes or no, and why? I would welcome any suggestion. No, that is not true, Alicia, right? Why?
According to me, it's not true.
Mm-hmm.
Because your company cannot pay interest with EBIT,
Mm-hmm.
but maybe with retaining
reality, if you allow me, the interests are not even paid from earnings. The interests are paid from the cash flows. So this means that I want to understand if in the long run I'm generating enough profit to cover for the interest, because I recognize that the earnings or profit will be compatible to the cash flow amounts, but basically at the end I'm paying the interest out of cash flows, not out of earnings. So that is not necessarily. We have to look at the cash flows. And that's why we have the analog formula of the coverage of the interest, but that compares not the EBIT, but the cash flows from operations to the interest expenditure. We introduced this new ratio at the last chapter, last time. And we said that every new ratio that includes items from the cash flow statement is an attempt to use a more qualitative indicator. And that is item that comes from a more reliable statement, cash flow statement. You cannot lie with cash, we said. So we make several attempts to use more useful ratios, okay? So not necessarily. You may have either some negative, right here we have negative interest coverage ratio, but what we do? We don't have it here, but we have a look at the cash flow statement. Are we generating enough money from the cash flows from operations? In case this net income or net loss over here includes a lot of accruals. What are accruals? Accruals are increasing receivables, increasing inventories that do not mean necessarily that we are paying money out of that. And this means that the cash is in the company even though we are having a loss. We may be able to cover the interest, but again, we cannot say that without further information. So not necessarily, we have to look at the cash flows. Okay? Questions?
I want to ask, like the return on assets, is there some threshold for that?
Usually, okay, at your textbook is not mentioned, but personally, I like to use the threshold for return on assets. I'm just writing here at this line, threshold for ROA is interest rate of loans or deposits. Usually many analysts use this as a threshold. It makes sense because sometimes we say that if I'm taking some loans, we don't have the interest rate of the loans here. No, we don't have that. Sometimes the financial statements say, for example, 10% loans. Okay, if I have to pay 10% on this loan, that means that if I take this money and use in my company, I have to generate a greater ROI in order to be able to cover the interest and to have something left for me. So the general threshold for ROA is interest rate for loans. Okay, so that means, and that makes sense, if I take some loan and use in my company, I have to generate ROA which is higher than the interest rate of the loans. So I may be able to cover the loan and have something left for me. Does it make sense? Whereas, usually a very rough approximation for ROA, the threshold is interest rate for deposits. So for ROA, the threshold is the interest rate for deposits. That means that as a shareholder, you have to make a decision. If you have, for example, 1,000 euro and you want to invest, you have basically two simple options. One is to go to the bank and deposit that amount of money and earn the interest. The other option, of course there are many other options, but basically the other option is to buy shares of a certain company. And if you become the shareholder or if you become the owner of the company, you are earning the ROA. That means that you are requiring a greater return from your investment in a company that you had as a return from your investment in deposits. The return that you are having from investing in deposits is the interest rate of the deposits. But of course you are requiring for a quite larger return on equity because you are undertaking more risks by investing in a business rather than just depositing money in the bank, right? So this is just a very rough approximation over there. But basically you have to, maybe it will be helpful to remind yourself about this. ROA usually is compared to the interest rate of loans and ROE to the interest rate of deposit. Does that make sense for you? Of course, there are more advanced and sophisticated models to calculate the weighted average cost of capital and to compare that with the returns, but that I will leave that to more advanced financial courses you are taking in the future. For the moment, this rough approximation is enough, I think. Any other questions?
The interest rates are the medium ones, right?
Sorry?
The interest rates we've been talking about are the medium ones of the market.
The interest rate of the loans that you as a company are taking. So they are not the medium interest rate in the market. Because as a company you may have some lower interest rate because of your good performance. So it would be desirable, favorable, if you have information, to have the interest rate of your loans as a company. In case you don't have that information, you can take the average interest rate in the market. That is quite okay to use. The same is valid for the deposits. Actually, this is the average interest rate in the market for the deposits, not something connected to the company. So yes, you are right, for the deposits is the average interest rate in the market. For the loans, preferably it should be yours own interest rate. Okay? Questions? We have another problem over here. There are the account balances for the working capital items of a certain company. Remember that the working capital accounts relate to both current assets and current liabilities. And we have them detailed over here, cash, trading securities. Now you see that the trading receivables are represented in their gross amounts, less the allowances for bad debts, that is, allowances for trade receivables that are probably not going to be collected, and this value over here, 230,000, represents the net trade receivables. That is the amount of the trade receivables that I am probably going to collect in the next period. And then we have the items of current liabilities over here. We are required to calculate two different ratios and then to indicate the effect of each of these transactions on the current ratio and the asset-based ratio. Okay? So first of all, let's calculate the current ratio. Actually, that is equal to the ratio between current assets to current liabilities, and that means that for 2020, which is the year that we are talking about, that would be the division or the ratio between this value, 688,000, and the current liabilities, which is 290,000. Okay, if we calculate that just to advance, I think that I have the calculations, yes. That is 2.37 times, or 237%, if I would calculate that in percentage. What is a common that we might want to do about the current ratio value? Is it enough or it's not enough? What is the benchmark or the threshold? It's not a threshold basically, it's an optimal value. What is the optimal value over here? More than one. Could it be 10 times? Because if we say more than one is the threshold, higher, it's okay. Can it be 10 times?
It's not good for the long term.
If the current ratio is too high, it's not good for it's okay for the liquidity position, but it's not okay for the profitability position. That means because if we have too many assets, current assets, compared to the current liabilities, it means that we are keeping too much inventory, too much trade receivables, too much cash, and all these items that I'm mentioning have a high cost of maintenance. They do not bring income. Usually they cost me to maintain. To have many inventories, it's a cost for the company. To have many trade receivables, this means that I'm financing my clients. That is also costly for the company. This is why we are talking about an optimal value. The threshold is 1 and the optimal value is around 2. Higher than 2 means that we are keeping too many current assets items compared to the current liabilities, maybe more than is necessary to properly manage the activities, okay? If you know what I mean. So again, the value 10 times that I mentioned is really beyond any logic. 2.37 times, actually it seems a little bit large. If we can see here the values of various items, we can see that actually the company is having a lot of inventory, 300,000. And the company is having a lot of trade receivables, 230,000, okay? And that means that the company is having too much inventory for which it should pay the cost of storage, the possible cost of declining the value because it will go bad or economically it will be unable to sell this inventory and other factors. So we have to keep this in mind whenever you analyze and compare current assets to current liabilities. 1, it's okay, like a threshold or a minimum amount. The optimal value is about 2 or even 1.5 for companies that have good access to financing in the short term. 1.5 can be okay. 2 is also okay, but more than 2 is risky. I'm sure that if you have calculated the current ratio for your companies, for many of you it's less than 1. Is that true? Okay. Is that risky? Is that does that mean any problem to manage the liquidity? If the current ratio is less than 1, does that mean any problem for managing the liquidity of the company? What do you think? Current ratio less than 1. Should we start the alarms ringing? Yes. Okay. Any other idea?
We need to check the cash flow statement.
Okay. We have also some answers in the chat. It depends on the payable turnover. Okay. It depends on the cash flow. That's still okay. Again, something else that I mentioned is that in the recent years, companies may afford to have a current ratio less than 1 because they're easy access to the money market. Easy access to money market means that they can get financing really fast and easy. If they are short of cash, because having a high current ratio means that you need liquidity to cover for your debts, short-term liabilities, right? That means that you keep cash, you keep receivables, you keep inventory because you will use them to pay your current liabilities. This is the meaning and the idea. But if you have very fast access to the money market, you need cash. You can access the money market by issuing securities, short-term bonds, and you raise capital. You don't need to keep so much money. You do not need to keep so many trade receivables or so much inventory. This is why almost all the companies that we are going to present have their current ratio below 1. They are all big companies, consolidated, and have easy access to the capital and money market. They can get financing whenever they want with low cost and very fast. And that means that it's not necessary for them to keep high values or high numbers in the items of the current assets. Okay, please keep this in mind whenever you try to analyze the companies. Something else that I want to mention about the optimal values of the ratios over here. Probably you have read also sources over the internet about different ratios, and they talk about the optimal values. Now, these optimal values are derived specifically based on certain sectors which are not really relatable to the current business environment we are operating. Most of these optimal values belong to the 70s and 80s of last century into a business world which does not have very much to do with the business environment we are operating right now. It was not an easy access to cash or liquidity. That means that we mentioned the optimal values of many ratios, but the business environment and features have changed a lot. So we need to see for ourselves the companies that we are analyzing, how are they doing? What is the new profile that they are introducing to us about the new companies in the recent years? Okay, I want you just to be very attentive whenever you try to interpret or analyze any outcome or finding. The other ratio over here is the asset test ratio. That is basically the difference between the current assets less inventory divided with the current liabilities. Actually, if we calculate that, it will be 1.34 times. Again, I would mention the same kind of interpretation over here. The acid test ratio or the quick ratio, it is not meant to be above 1 time. This means again that this company is probably having too many investments in short-term items like inventory or cash or the trading receivables. So it's higher. There is no problem for liquidity over there, okay? So the liquidity position is really consolidated. The problem is the effect or the impact on the profitability of these items are meaning or are they imply that we have some costs associated to each of them, and we should not forget that, okay? The second requirement over here takes us to the specific transaction listed for which we have to estimate the effect on the two ratios, that is the current ratio and the acid test ratio. So I'm adding some columns over here. The first one will be the current ratio. And the second one will be the quick or the acid test ratio. We know the formulas. Now I am reminded, I think, with the footnote somewhere with the, okay, this is something that sometimes we forget, but mathematically, if a ratio has a higher value than 1, decreasing the two elements, numerator and denominator, by the same value actually increases the ratio. That seems counterintuitive, I know. But that is what math says, financial analysis. I checked with real numbers and it is true. When you have a ratio bigger than 1, when you decrease it by the same amount, both numerator and denominator, the value of the ratio will actually increase. Okay, that is true. I checked that, so you can, yes?
For the same value, you mean nominal value, not percentage value, right?
Nominal value. For example, if you have the current ratio 2 times, and you use cash to pay suppliers, that means that you decrease cash, current assets, and you decrease suppliers, current liability by the same amount. The value of the current ratio after this transaction will be higher than 2. Okay? Good. Having this in mind, whenever it is useful to use, let's analyze the first transaction. If we purchase fixed assets for cash, or do you need a break before we continue? I think that 5 minutes break is okay, over which I'm going to complete this table, and then we continue after 5 minutes, okay?
然后我就要去上班了。
很好玩。Oh my god.
I think that now we know how to tackle this kind of exercises, so we are trying to go fast, let's say. If we purchase a fixed asset for cash, so we use cash to increase the non-current assets. What will happen to the current ratio? What do you think?
就吃了个菜。
What will happen to the current ratio? over there?
Decrease.
We have a decrease in the current ratio and the same thing with the quick ratio because we are using cash to buy something that will affect another section of the financial statements, not current assets or current liabilities. Exchange the common stock for land. Estimated value of transaction, a certain value over there. So we exchange common stock for land. Any change in the current ratio? No. Any impact in the quick ratio? Neither for this one. Payment of short-term notes payable. This resembles the example that I mentioned before. If you use cash to cover or to settle a short-term liability, like this short-term note payable here, this means that you are having a ratio which is currently above 1. Remember that both current ratio and quick ratio are more than 1 time. That means you are using the same amount, you are decreasing the both elements of this ratio by the same amount, and that means that the actual ratio value will go up. Okay, remember the rules. And also, if you want, please, dear student, if you want, check for yourself. Okay, you have the values of current assets and current liabilities. You have the value of the transaction here, which is 40,000. Prove and check for yourself. Is indeed the value of the current ratio and quick ratio increased? Okay. So trading securities costing for 25,000. That means that we are selling for a gain. We are selling at a gain, at a value which is higher than the cost of purchasing. Okay. What does that cost to the current ratio? Will it be changing? I say no, and neither the quick ratio. Why? Because, sorry, my mistake. I mentioned the gain and I totally forgot. We are selling trading securities, 20,000, they are part of the current assets, remember. And we are exchanging them for 25,000 in cash. So after this transaction, the current assets will be increasing by 5,000. Okay? Whereas the current liabilities will not be changed. That means both current ratio and quick ratio will go up, will increase. Issued common stock for 70,000, and I assume this is in cash. Increase in cash means that we have an increase in the current ratio and also the quick ratio. The current liabilities will not be affected by this transaction. Declare the cash dividend. When we declare the cash dividend, remember the dividend, declaring the dividend does not mean that we are paying that. So remember that. But if we declare the dividend, we assume a liability. That means that we will show the liability of payable dividends under the current liabilities. Okay? So the current liabilities will increase. That will cause the decrease of the current ratio and the quick ratio as well. Why? Because the current liabilities will increase by the value of the declared dividend. Now, you pay this cash dividend. You decrease cash in the current assets, but you also decrease the declared dividend as part of current liabilities. We are at the same terms as before. We have an increase in the value of the ratios because actually they are higher than 1. And decreasing both elements of the ratio will make the value go up. Okay, sold inventory. The cost of inventory is 10,000 and it was sold for 50,000 cash. That means that the current assets after the transaction will be 5,000 euro higher than at the beginning. That means that the current ratio is increasing, right? Because the current assets are increased, we diminish the inventory with 10,000, but we increase cash with 15,000. What about the quick ratio?
Increase.
The quick ratio is not affected by inventory. So whenever you sell, you buy, you purchase inventory, no impact in the quick ratio. But still, you have increased cash. So increasing cash means that you have increased the quick ratio. Sold inventory costing 5,000 for 80,000 on account though, not on cash. What does that bring to the both ratios? Now, if I sell inventory 5,000 and I exchange this with 80,000 in trade receivables, again the current ratio will increase because the current assets will increase by 3,000. Okay? Do I have any change in the quick ratio? Okay, the value of the inventory is not changing. Sorry, it's not impacting the quick ratio, but still the quick ratio is impacted by the current assets. And the current assets are going up, are increasing. So the quick ratio will be affected, will be increasing. Okay? Pay trade payables in the amount of 20,000. So again, this is in the same line of discussions that we already made. We have two ratios, current and quick ratio, actually higher than 1. And we decrease the values of numerator and denominator with the same amount because we use cash to decrease trade payables. That is, the value of the ratio will go up over here. Sold trading securities costing 20,000 for 20,000 cash. That means that we have no gain from selling these securities. Basically, the amount of the current ratio will not change because the amount of the current assets will not change. You are basically just shifting the amount from the trading securities to cash. So zero impact, and also the quick ratio will not be affected. You get that? So you are selling trading securities, current assets will be decreased by this value, but you are exchanging that for cash. Increasing cash will change the current assets to its previous value. So it will be not changed. Any question? Anything to clarify over here? I think that we got, let's say, we know now how to calculate the values of this ratio, how to solve these exercises. Okay, we have something similar over here. I think that we are going very fast with that as well. Again, we have some transactions and we have to show how they impact the indicators over here. We have the current ratio, we have the debt ratio, we have the net income, we have the stockholders' equity. Now, the last two items are not financial ratios, they are items from financial statements. Net income from the income statement and stockholders' equity from the balance sheet. So, a cash dividend is both declared and paid. Does that affect the current ratio?
Yes.
The initial value is higher than 1, whereas the debt ratio is lower than 1. Whenever a certain transaction affects both elements in the ratio, we should remind of the rule that we said. So if we declare and pay the dividend in the same time, what does that cause to the structure of the financial statements? If we declare and pay the dividend in the same time, we have a decrease in the current assets and also an associating decrease in the equity because dividend is an appropriation or distribution of profit. Long story short, the current ratio is going to be decreasing because the current assets are going down, but not the current liabilities. The debt ratio, actually in the debt ratio, which is total debt to total assets, the total debt will not change, but the total assets will decrease because I'm paying money, okay? So the decrease in the total assets will make this value, the value of this ratio, be higher after the transaction. Again, the debt ratio will increase not because we have increased debt, but because we have decreased equity, because we have paid dividends. Is that okay? Net income. Good, stockholders' equity, we mentioned, minus. Cash is obtained through long-term loans. Do not consider interest. That means do not think that, okay, I'm taking the loan now, but after 1 month I have to repay it back together with the interest. Don't think too far in the future. Just for the moment, you are having cash inflows because you are taking a long-term bank loan. The current ratio
Increase.
is going up because I have more cash. The debt ratio, you have more debt
Increase.
compared to more assets. The current value is lower than 1. That means that for a value or for a ratio that is lower than 1, when you increase both numerator and denominator by the same amount, the value will go up, will increase. The net income, 0. We said that we are not considering the interest expenditure yet. Stockholders' equity, no impact. Okay. Equipment is purchased with short-term notes. Again, do not consider interest if you are purchasing in short-term notes with interest. That's not a natural transaction, but let's take it. So we have short-term notes. No change in current assets, increasing current liabilities, current ratio is decreasing. Debt ratio, you have more short-term notes. You increase the total debt, you increase the total assets as well. The current value is lower than 1, increases with the same value with increase. The ratio, the net income, no change. Stockholders' equity, no change. Merchandise is purchased on credit. Current ratio, you increase both inventory and the current liabilities because we are buying or we are purchasing on credit. You have a value, you have a ratio which is higher than 1, and increasing both elements with the same amount will cause the ratio to decrease. Whereas the debt ratio, what will happen? We have an increase in the total debt because this is trade payables that are increasing, also an increase with the same amount in total assets, but the value is lower than 1, that is the total ratio will increase. The net income, no impact. The equity, no impact. A fixed asset is sold for more than its carrying value. That means that we have a gain from sale of fixed asset. Any change in the current ratio? Assume that it's sold for cash. It's not said here, but let's assume we have cash in exchange. If we sell for cash, of course, we increase cash and the current ratio will increase. The debt ratio. The total debt actually will not be impacted by the selling of fixed assets, but right now I have less assets. Having the same amount of debt compared to the lower amount of total assets, that makes the value of the ratio go up. Do we have any impact on the net income? Yes, we have a positive impact because we have sold for a gain. We have sold fixed assets at a gain. Stockholders' equity, any impact on that? Remember that if you are selling for a gain, you have an increase in the net income, and ultimately the net income is a component of the stockholders' equity. So of course we have an increase in the stockholders' equity as well. A stock split takes effect. No change in the current assets or liabilities, no change in the current ratio, no change in the debt ratio. Something is changing only in the structure of the equity, somewhere in there, not the amount of the equity, but only the inner structure. No change in the earnings, no change in the stockholders' equity. The total amount of stockholders' equity is the same. What is changing is only the number of shares, and the value of each share is lower after the stock split. Current operating expenses not previously recognized are paid. Basically, we are using cash to pay this expenditure. If we diminish the cash amount, we are decreasing the value of the current ratio, right? So we are paying less cash, less current assets, a lower value of the current ratio. They are not previously recognized means that they are not actually part of current liabilities. We did not find this item included in current liabilities. They were not recognized previously. I just recognized them and paid them immediately. So only cash is being affected. What about the debt ratio? If we have less assets for the same amount of total debts, that means that I have a higher debt ratio. Are we going too fast?
I didn't get this one.
This one. Okay.
But they were not recognized.
Yes. Of course, no change in the total debt here. The change is in the total assets because you are paying through cash. Yes, cash is reduced.
And so why we had last
Step ratio.
Okay, because the debt ratio is the total debt to total assets. If you have less total assets, mathematically, if the denominator is lower, the value of the ratio is higher. I know there is too much math in this.
我觉得是因为大家都累了。
真的已经不这样了。
That's why, because it is too much math, I put this rule over here. You are free to take this with you in the exam. For me, I don't remember it by heart, I just remember one thing. If you pay suppliers with cash, the value will go up. And by that, you can construct all the 4 different situations, okay? If you can memorize like this, it's okay. Otherwise, write it down somewhere, take with you in the exam. I completely know that. For me, this was something that I had forgotten from math. And when I prepared the tutorial, I had to check for myself, is it true? Because it sounded not really intuitive or logical enough. And actually, it is true. So there is much math involved in order to see the movements of the elements, but this is the explanation for the increase in the value of total debt. Okay, so net income, if I'm paying some current operating expenditure, if I've not recognized them previously, I recognize them as expenses now. So this means a minus impact in the net income. And if we have net income decreases, we also have the stockholder equity decrease. Why? Because we said that the net income is part of the stockholders' equity section. A firm recognizes depreciation expense. It does not pay anything, it just makes the classic journal entry depreciation expenditure to the accumulated depreciation. Does it change anything to the current ratio? No. Does it change anything to the debt ratio though? Okay, why?
because total assets decreased.
Okay, for the same reason as before, well, the net income, of course, is decreased because depreciation is an expenditure. It's not a cash outflow, but still it is an expense. So a minus at the net income. What about the stockholders' equity? That's easy. The same thing that will impact the net income will have the same effect on the stockholders' equity. Okay, a firm refinances short-term notes with long-term notes. What does that cause to the current ratio?
Liability decrease. So
The current liabilities decrease because basically they are converted to long-term liabilities. The total debt is the same, just the maturity is changing. From short-term, it becomes long-term. This is the basics of that transaction over there. So we refinance a short-term loan note with a long-term one. The total liability is the same. I'm just moving or switching the maturity times, okay? So basically, this will not change anything. This will change by decreasing. This will increase the current ratio because current liabilities will be lower than before. What will that cause to the total debt ratio? No change. We said that the total debt will not change over here. What about the interest expenditure? The net income would be impacted if the movement from short-term to long-term would cause a decline or an increase in the interest rate. And that is actually the case in reality. But right here, we are advised not to pay attention to the interest. So no change in the interest. That means no change in the net income and no change in the stockholders' equity. Any question regarding the impact of transaction? Be aware because almost always we have included in the final exam at least one or two transactions for you to measure the effect on certain indicators. Okay, probably you saw the structure of the exams for yourself. Why, if we increase long-term notes, that ratio doesn't increase? If you are referring to the last transaction, transaction E, that is because you are in the same time decreasing the short-term notes. So you are basically only restructuring your debt. This is a debt or loan restructuring. It's not a change in the total amount. Is that clear now? Okay. Okay, we have a question from to explain again point. If any one of you can give some insights or thoughts over here. Current operating expenses not previously recognized are paid. Now I will write something that probably you will not like very much, which is the accounting entry for this, or the journal entry. So the accounting entry is debit, operating expenses to credit, the cash account, okay? So that means that if you are increasing the operating expenditure, you will have a negative impact in the net income and in the stockholders' equity. That's done. If you are using cash, you are decreasing cash. That means that you have less current assets and therefore lower value of the current ratio. Now, whereas the debt ratio over here, you have the same amount of debt, but you have less assets. And mathematically, if the denominator is lower, the value of the ratio itself is higher. Is that more clear now? Okay. So, exercise 5 here, actually, we are not required to calculate anything. We are just required to comment and interpret the trends of the ratios. That means that I'm leaving you for 2 or 3 minutes to have a look at what the ratios are, what they imply, and then together we are going to have some conclusions. What is going on over here? So, trend in liquidity. This is what we are required to see. Then solvency, long term, okay, and then the profitability, the last one, okay. The first ratios relate to the liquidity. This part over here relates to long-term debt paying ability or solvency, and probably the profitability is related to this part over here. Of course, we have interconnection between ratios, but you know where to look for each of the requirements. Okay, if we are ready to analyze the liquidity, I think that it is pretty easy because it directs your attention to the problematic areas, which are the management of receivables and inventory. Now, do you see anything that we can write over here? For example, explain the trend in liquidity. What can we say about the trend in liquidity? We start in 2016. We observe an increase in current ratio, and the same trend we observed in the quick ratio. So we have increase in liquidity, for the not very attentive analyst, we would say everything is going perfectly. But if we go, if we become more suspicious and we investigate a little bit further, the increase in the values of several items from the current assets, I warned you, that may be problematic for the company. And actually, you see two items that are part of the current assets, and that is the debtors days period. From 35 days, almost 1 month, it has gone to 61 days, 2 months. That means that I am allowing 2 months of financing, which is free financing for customers. They are not required to pay anything. Basically, I am financing their activities. So, the increase in the debtor days means worse management of debtors. Usually the increase in the debtor days means that we have higher amounts of trade receivables. And having higher amounts of trade receivables explains the increasing trend in both current ratio and quick ratios, okay? So the problem that we are encountering with the management of the debtors is something that we have to look further and we have to investigate. At the first sight, I may conclude, okay, for the liquidity, no problem at all. We have an increasing trend in managing to cover for the current liabilities. Yes, but which item? Inside the current assets, which item is increasing? And we see that actually we are increasing the trade receivables, which is not good. Because increasing trade receivables means that you are not able to get the money back from your customers. What may be the reason for that? It depends on many factors. Maybe you have chosen this business strategy or business approach to your customers, or probably the customers are having financial problems, difficulties that they reflect your own activity. What we are trying to say is that do not focus only with 1 or 2 ratios and say that something is going quite okay. Look further and investigate further to see the source and the reason why is that happening. We also see the merchandise inventory turnover. It is increasing over here. Is that a good thing or a bad thing?
Bad thing, because it means no.
Careful. This is a source of confusion because debtors days increasing is not good, because we mean that we have higher values of the trade receivables, but the turnover increase in merchandise is a good thing. Remember that the turnover compares the cost of sales with the inventory, and this means that you are turning it over or you are exchanging inventory for cash faster. So this means that the increase or the improving trend in the inventory turnover relates with the decreasing trend in the receivables. You are selling more, okay? This is obvious from the increase in the turnover, but you are not able to collect the money. Can you get what is going on? So you are selling more, and this is obvious because the turnover of the inventory is increasing. You are selling faster, you are keeping the inventory for shorter periods in your company, but you are not able to collect the money fast enough. Is that understandable? So, means worse manage of debtors. Improvement. Okay, we may say that. So improvement of the turnover of inventory means that we are selling faster, but we are not able to collect money as fast as we can sell them. Is that something good in itself? Just turning over or increasing the turnover of inventory? So we have to be aware of the debts over here. That means that trying to sell more and faster, we are attracting to the companies that are not very serious customers. They are buying, they are purchasing, but they are not very good at repaying their invoices. So this is a risk that the companies usually undertake. So it seems in the first side that we are able to manage the liquidity, we are able to cover the current liabilities, okay, but at what cost? Which is the item that gives us this increase in the current and the quick ratio. When we investigate further, we find that this is the trade receivables, and we don't want that because connecting together the increase in the debtors days with the improvement in the inventory turnover means that we are selling fast, but we are not collecting the money. And that basically means that we are attracting customers who are not really qualitative. They are not paying back their liabilities to the company. Does that make sense? Okay. Is it comprehensible how we combine ratios together? Is it difficult to do? Yes. Or you are too tired right now to understand, but basically this is what we are required to do in the ratio analysis. And compared to the exercises that are in the textbook, believe me, this is very simple exercise. In the textbook there are some more advanced exercises. I'm not saying that because I want you to go through those exercises. I'm just saying that this is something more simple that I'm trying you to get familiar at least before you try to analyze your group work project companies. If you have any question, please let me know. Okay, can we do the same thing about the solvency? So again, you know that you have to combine together the results. We have basically only two indicators over here, the total debt and the interest coverage ratio. Come on, to comment on the trends is not difficult. So I wrote that. Do you agree with me? The total debt ratio is somewhat stable. Is that stable almost over the years?
Mm-hmm.
No. So the total debt ratio, we start from 47%, 49, 50, 48. I would say that it's somewhat stable over the years. There is not a visible trend over there. But what we can see about the interest coverage ratio is a visible and very easily identifiable trend. We start with 6 times, and then we have a decrease, which is obviously there for almost all the years, and we end up with having an interest coverage of only 4.6%. How is that possible? Why the interest coverage why the interest coverage may decline or can decrease over the time. What are the reasons that it can happen?
Interests are growing.
First one, interest rates or interest expenses. Alicia, which one?
Expense.
Okay. Interest expenses are growing. And that means that the interest coverage will decline, obviously. Another reason?
Operating profit will
Yes, EBIT is declining. Okay. Now, when we say the interest expenses are growing, I may relate that to two different possibilities. Interest expenses are growing either of increasing total debts of the company. I have more debts, I have more interest expense. Do you agree with that? Or another reason is this is not the case of our company. We do not have more total debt. We have somewhat stable debt that is not really explaining why I have a lower interest coverage. So the interest expenses will grow either if I have more debts in total, or another reason if I when I can pay more interest with the same amount of debts.
Interest rate is increased.
Another reason is that I may have the same amount of debt, but we have increase in the interest rate in markets, and many debt covenants or loans are quoted with variable interest rates. You may have heard LIBOR plus a percentage or Euribor plus a percentage, and these Euribor are indexed in the market interest rates. So even you have the same amount of debt, it is indexed with the interest rates in the market, and the total interest expenses will go up. So remember, there are three different reasons why the EBIT will decrease. First of all, you'll have interest expenditure growing for either reasons, or EBIT is declining. Which one is for our company? Can we have a look at the profitability so as we can see what is going on with the EBIT and to conclude for ourselves if we have a declining profitability or not? Okay, so let's see the net profit margin has declined substantially. Why? And that is true. Net profit margin from 9.3% ends up with only 7.6%. Why is that so? Here you have everything you need to have an idea. And having answered that, this is the last thing we can do for today. You see that the sales are increasing. The sales are expressed as a percentage on the sales of 2016. So you start with sales expressed as 100% of the base year, and then you have increase, a further increase, increase again, increase in the 2020. So sales are increasing, obviously. The net income as a percentage of a net income of 2016. Again, we start with 100%. We have an increase in the net income, a further increase, but you see lower than that of sales. Another increase, but again lower compared to the increase in sales. Again, the same thing in 2020, an increase in net income, but again, an increase at a lower rate compared to sales. Now, usually the companies, when they extend their operations, when they grow, they tend to grow both sales, okay, and the accompanying expenses. That means that sometimes the companies, while growing, they can have their costs going out of control, increasing faster than the revenues or the income. And usually what happens to these companies is that while they grow and expand their operations, their expenditure will grow more than revenues, having as a final result a an increase in the net income, but not at the same rate as the sales themselves. Why? Because sales have increased, but expenses have increased at a faster rate, and that means that we have an increase in the net income, but at a lower rate compared to the sales. Has this reality happened for the company? You see here that we have some information hidden in the gross profit margin. Yeah, the gross profit margin is decreasing over time. That means that the cost of sales margin is increasing. It's taking more and more part out of the sales revenue to be covered with. Okay? That also means that if you increase the trend in the operating expenditure, it is also increasing at least in the last year over here. That means that this company, of course, it is increasing its sales revenue, but it is also increasing the expenditure. And the final result is that as we are increasing expenditure more than revenues, the net income will increase, but not at the same rate as the sales, as we may notice over here. That, of course, explains the net profit margin decreasing. Why? Because we are not increasing with the same rate, and the return on total assets, because it depends on the net profit margin, will also have a declining step or declining percentage. All that we commented by the end of the lecture today, I will write down in the material and I will post in the Moodle as a solution for today. And tomorrow we'll continue with what we didn't complete today, even the lecture and also the exercises, okay? Please let me know if you have anything